I think we're at a really interesting point at the moment in the cycle, and I've got a feeling like something's about to break over the next couple of months. And what I want to do in this video is really walk you through what I'm watching and the key elements, the key global indicators that I believe are the most important to be watching if you're any type of investor, particularly a real estate investor or a stock market investor. Well, what I've got here is US 10-year yields. For those of you that aren't familiar with this, basically this is what 10-year interest rates are doing in the United States. And as you can see, we've been coming down for a couple of decades. We've been trending down from kind of like the mid-teens in the late 80s down to the high single digits in the 90s, and we bottomed. We bottomed at zero during the pandemic. Ever since then, we've been coming back, and interest rates have been rising now for the past almost 2 years, year and a half, 2 years. But the pace of increase in 10-year money is really important. And the rate of increase in 10-year money is going to have a profound impact on markets, and I'll explain to you why in this short video. When interest rates rise, it means that the bonds that are out there are falling in value. So a bond is basically a government debt. They pay back a certain amount, and the value of that bond goes up and down. And the way we price that is through the yield or the implied yield. So when your yield goes from 4% to 5%, that's a 25% move, right? Because 1% divided by 4% is 1/4. That's 25. So what's happening in the market is not only are interest rates rising in the US, but the value of all the US government debt is falling. And that's going to have a big impact because there are a lot of investors. This is the most liquid bond market in the world. This is an asset class worth trillions of dollars that's held widely all around the world. If you think about your pension fund, in Australia, we have mandatory superannuation, mandatory retirement savings, and within each fund, there's a certain portion allocated to bonds. And a chunk of that is going to be allocated to US government bonds. And the value of those bonds are falling. And so you extrapolate that across the entire economy, and you're going to find that there's a lot of insurance companies, there's going to be a lot of annuity businesses, there's going to be a lot of investors sitting on big paper losses of US government debt. Eventually, that's going to blow up. We saw that blowing up in the UK about a year ago. The Bank of England came in, but since then, rates have continued to rise. And what's really, really caught my eye is just the extent of the increase in such a short period of time, particularly over the past couple of months. I mean, moves like this on US 10-year debt, we've seen yields rise from, barely 3% to now almost 5% over the space of the last year. This is huge. This is going to crack the system. I don't care what anybody says. At some point, there's going to be an institution out there that's caught holding these bonds, sitting on big losses. They're going to have to liquidate. It's going to cause a cascade. And again, regulators are going to have to step in. I don't know if they're going to contain everything, because at some point, I think something really, really big breaks. This is also happening against a global environment that continues to get trickier and trickier. I don't know what will happen geopolitically. I'm not a geopolitical expert. What I do have experience with is market cycles. And I know that things break in markets. And I know that when things break, regulators and governments step in to save the system. So I'm watching this, and I'm seeing a strong, still a strong US dollar, still very, very weak counter currencies. The Australian dollar, for example, is very weak. I think it's bottoming. I think it's basing. I think there's central banks around the world like Australia and Canada that are watching this thinking the US is going to have to go it alone. We're not going to we're going to try to hold on to interest rates at these levels because we don't want to break our own economies. And it's a really, really tough, tricky, murky outlook. At the same time, the real estate market, the residential real estate market, is holding up relatively well. At the same time, the jobs market in most developed economies continues to experience really low unemployment. At the same time, the cost of building real estate continues to go up, underscoring real estate values. So residential real estate is set up, I believe, for the perfect storm, because rising US interest rates have been a result of rising inflation. That rising inflation has put a floor on building value because it costs so much to replace housing. And at some point, these rising rates are going to break something. They're going to snap the system. And when that happens, regulators are going to have to come in and put downward pressure on interest rates. And so I think the smart real estate investor in this market is focused on one single thing. They're focused on income. They're focused on making sure that they have an asset that has income power, that has pricing power. And what that asset is an asset that can continue to increase its income as interest rates increase. And when interest rates come down, that income is sticky. That's where I think the smart money is going to be made in residential real estate over the next 2 to 3 years. I think the best time to have been buying residential real estate in hindsight was about a year ago. You probably got some great bargains. It's still a great time, but you have to buy assets that have pricing power in their income. You need to buy assets that are very well placed close to, for residential, you want to be in metropolitan centers, you want to be close to infrastructure, you want to be buying something on the value chain. What I mean by that is you want to be buying something that has price growth, income growth, has got a margin of safety baked into it, is not too leveraged to the financial system or the stock market or things like this breaking. Commercials turning around, particularly office. There were people writing off the office asset class, and office has been a horrible place to have been invested, but there's a little bit of hope coming out. There's some green shoots. Again, to me, that's because the value of these office blocks is just very expensive and difficult to replicate. And so you're going to have a lot of smart investors looking at that, thinking, can we reposition these things? Nevertheless, I think if you're going to be watching anything over the next few weeks and next few months, you want to keep your eyes on what's happening in the US. You want to keep your eyes on this. It's called the US 10-year government bond yields. And as you can see, every time you get these big rises, steep rises, they're followed by falls. You go back recent history, it doesn't necessarily mean that things are going to repeat themselves, but the trend shows us that every steep increase is followed by a subsequent decline. And, this increase has been very, very significant. So, guys, that's what I'm watching. If you're an investor in the market, I think watch this. I think if the US 10-year government bond yield goes above 5% and stays there for a few weeks, for a few months, something is seriously going to crack. And residential real estate is a place of safety. Residential real estate, when done right, is a great way to protect against the debasement of currency. And residential real estate that has income and income power is the most sensible way to play it. Hopefully that's been of value to you. Thank you.